Everyone's watching the same old story. They're glued to the headlines about SEC ruling ETF flows and trying to predict the next market top. But they're all looking in the wrong direction. While everyone is staring at the bright flashing lights, they're missing the quiet structural decay happening in the real shadows. The real story, the one that could send Bitcoin spiraling, isn't being debated on TV. It's not just one thing but a toxic cocktail of two hidden time bombs. One is a macroeconomic powder keg, wound so tight that one wrong move from the central bank could set it off. The other is an internal sickness in the crypto world itself, a weakness that even Bitcoin's biggest fans refuse to admit exists. The mainstream won't show you this, the crypto influencers blinded by their own holdings certainly won't, but right now I'm going to connect the dots. I'll break down the two biggest risks to Bitcoin's price that almost nobody sees coming, and by the end you'll understand this market in a way that 99% of investors simply do not. Let's start with the risk everyone thinks they get, but whose true scale they completely underestimate: the macroeconomic environment. For years, Bitcoin has been the ultimate beneficiary of one simple thing: cheap and easy money. Think of the global financial system as an ocean. When central banks print money and cut interest rates, the tide rolls in, lifting all boats. But Bitcoin isn't just a boat, it's a high-performance speedboat, and it has been riding a historic tidal wave of liquidity. The link between Bitcoin and the global liquidity, specifically the M2 money supply, is incredibly strong. Some research has shown that Bitcoin's price and global liquidity move in the same direction over 80% of the time, a stronger connection than nearly any other major asset. Put simply, when the money printers go brrr, Bitcoin tends to fly. This isn't a coincidence, it's practically a feature of the system. In a world drowning in cash, scarce assets are king. But here's the danger everyone's missing: that tide is about to become dangerously unpredictable. Central banks, like the Federal Reserve, are caught in a brutal trap. They're terrified of inflation sticking around, but they're just as scared of causing a deep recession if they tighten the screws too much. This has created an environment of extreme fragility, where any unexpected shock can make liquidity vanish in an instant. We have seen what this looks like. For instance, a surprise announcement of new aggressive tariffs can send a shockwave through the market. We saw this on October 10th, 2025, when a threat of 100% tariffs on Chinese goods was announced. The stock market tumbled, but digital assets, being the ultimate high-risk bets, got hit first and hardest. In the days following the announcement, Bitcoin plunged, with some reports showing a drop from 120,000. This kind of macro panic can trigger massive deleveraging events in crypto. In the October 10th event, between 70 billion and 90 billion in leveraged positions were liquidated in just 24 hours, wiping out over 1.6 million traders. That wasn't just a market correction, it was a structural failure. A cascade of forced selling turned a geopolitical headline into a multi-billion-dollar catastrophe. This event exposed the first hidden risk. Bitcoin is no longer the uncorrelated digital gold that many believed it was. Its correlation with risk assets like tech stocks has become much tighter. In moments of geopolitical shock, it doesn't act like gold, which often rallied during a crisis. It acts like a volatile tech stock. When institutional investors panic, they sell their riskiest assets first to raise cash. Bitcoin is at the top of that list. So while everyone is watching the Fed for a tiny rate cut, they are missing the real story. The risk isn't a predictable policy change, it's a black swan event, a geopolitical flare-up, a debt crisis, or a sudden inflation spike. That forces central banks to pull the plug on liquidity. In that world, the wave that lifted Bitcoin to unbelievable heights will go out just as fast, leaving a lot of people stranded. The October crash was just a fire drill, and so is the November crash. The real thing could be much, much worse. If the macroeconomy is the external threat, the internal structure of the crypto market is the hidden sickness. These are the uncomfortable truths that Bitcoin maximalists hate talking about because they challenge the entire narrative. First and foremost is the myth of decentralization. Bitcoin's whole identity is built on the idea that it's a censorship-resistant network that no single person or government can control. But is that really true anymore? The data tells a different story. The network security comes from its hash rate, the total computing power of miners. The more spread out the power is, the more secure the network. But over the last few years, Bitcoin mining has become dangerously centralized. Today, a scary amount of global hash rates is in the hands of just a few companies. As of mid-2025, one American-based pool, Foundry USA, controls nearly 28% of all new blocks on the network. The top two pools, Foundry USA and Antpool, together controls almost 50%. And if you add the next two, F2 Pool and Via BTC, the number jumps up to over 70%. Let that sink in. The security of a supposedly decentralized trillion-dollar asset is effectively in the hands of 4 companies. Decentralization isn't just at the pool level, it's also geographic. The United States has become a mining superpower, controlling somewhere between 35 to 44% of the global hash rate. That means a huge chunk of that network security sits inside one country, operating under one government. And this is where the risk becomes terrifying real. What happens when a government facing a financial crisis or a geopolitical threat decides it wants control? What happens when the US government tells Foundry and other American pools to freeze transactions from certain addresses or block specific activity? Suddenly, Bitcoin's core promise of being unstoppable isn't a guarantee, it's a political question. A 51% attack where someone tries to rewrite the blockchain is usually dismissed as too expensive, but this isn't about a hacker trying to steal coins, this is about a government coercion. The attack isn't on the code, it's on the handful of centralized companies that run the infrastructure. This is the risk no one wants to price in. Bitcoin may no longer be the unstoppable force it once was, its backbone has been centralized and that makes it fragile. The second internal flaw is the house of cards known as the crypto derivatives market. Most people just see Bitcoins as priced on an exchange like Coinbase, but that's only the tip of the iceberg. Underneath the surface is a much larger and more chaotic market for futures and options. In 2025, derivatives trading makes up over 70% of all crypto trading volume, dwarfing the regular spot market. Some projections estimate the annual trading volume for crypto derivatives will top $23 trillion. Think of it this way, the spot market is like owning a house. The derivatives market is like a massive skyscraper built next to it, made of billions of dollars of bets on which way the price of that house will go. And that skyscraper is built on a foundation of pure leverage. Leverage lets traders control huge positions with very little money down. It magnifies gains, but it also magnifies losses, and this creates a terrifying domino effect called a liquidation cascade. Here's how it works. A small dip in a spot price, maybe like a macro shock like we talked about, forces over leveraged traders to be liquidated. Their positions are automatically sold. This forced selling pushes the price down even more, which then triggers the next wave of liquidation at a lower price. What started as a small tremor becomes an earthquake. We saw this play out horrifically on October 10th. That $19 billion wipeout wasn't caused by $19 billion worth of people deciding to sell, it was caused by a much smaller initial drop that was amplified exponentially by forced liquidations in the derivatives market. More recently, another dip in November 2025 triggered over $1 billion in liquidations in a single day as prices fell. And this is the second hidden risk. The spot price you see is a slave to a much larger, wilder market that most people don't even know exists. Bitcoin stability is constantly threatened by a mountain of leveraged bets that can collapse at any moment, turning a small correction into a market-wide crash. Now it's time to connect all these dots. The single biggest risk to Bitcoin isn't just the macro environment, and it isn't just the internal flaws, it's the deadly unseen interaction between them. Picture this scenario. A geopolitical event sparks a global liquidity crunch. Big funds need cash, so they start selling their riskiest assets, including Bitcoin. This causes an initial 5 to 10% drop in spot price, but that's just the start. The dip is the match that lights the derivatives powder keg. Billions in leveraged positions are liquidated, creating a cascade that sends the price spiraling down another 15 to 20%. At the same time, panic spreads, trust in the system fades, the headlines shift to the centralization of mining. Pundits start asking, is Bitcoin really censorship resistant? If a few CEOs in the US can get a subpoena, this erodes Bitcoin's fundamental value, causing even long-term holders to start selling. The external shock has now triggered an internal collapse. This is the downward spiral. This is the risk nobody sees coming. Some might argue that scaling solutions like the Lightning Network can save the day. The Lightning Network is a second layer designed to make Bitcoin's transaction faster and cheaper, and its adoption has grown. By mid-2024, it was being used for over 16% of Bitcoin's payments on some platforms. But Lightning is not a silver bullet for these deep systemic risks. In fact, it has its own issues. The public capacity on the network actually fell by about 20% from late 2023 to August 2025, dropping from over 5,400 Bitcoins to around 4,200 Bitcoins, which suggests fluctuating confidence or restructuring. While some of this is from funds moving to more professional hubs, it shows that even Bitcoin's supposed solutions are not immune to market fragility. With all this said, I still believe in Bitcoin, but it's important that people like you know the risks. It's very important to know that a crash can come due to these fears, and that it's not always 100% bulletproof. Thank you for watching, and I hope you subscribe, and I'll see you guys in the next video.